Great. Thank you, Michael. And thank you for joining us for this Financial Poise webinar. I am Candace Klein. I'm a bankruptcy and restructuring attorney at Saul Ewing and a law professor at the University of Toledo College of Law. I look forward to being your moderator today. This episode is part of one of the four-part webinar series called MBA Bootcamp. We open this episode with episode 2, How to Read a Balance Sheet and Why You Care. I am the moderator, and I am going to be working with our panelists on questions, and they might not be appearing in order. So as we go through the PowerPoint, certainly you can use that as a resource, but we will be moving around the PowerPoint. On slide 7, we summarize this episode, how to read a balance sheet and why you care. On slide 8, we also discuss the MBA Bootcamp purposes, and we provide for a list of our 4 episodes on slide 9. On slide 9, you'll see we started with EBITDA and other scary words. We're now doing balance sheet. We have 2 more coming up, which is KPI cash flow modeling. And the last one, where did all my profits go? Mastering the concept of working capital. Our panelists are listed on slide 5. We have Steve Strausser, the author of MBA in a Day 2.0, John Levitsky of HKA, and Terry Orr, also of HKA. We appreciate that you are not spending your time and money to hear infomercials. If you want to get to know us better, you may read about us in the back of the deck at slides 37 through 40. Financial Poise webinars are supported in part by sponsors. The sponsors for this webinar are the National Law Review, and the National Law Review is a premier legal news website, a trusted resource for attorneys, business leaders, and the general public. And information about National Law Review is on slide 3. Max Asset is another sponsor. They offer turnkey solutions to conducting online auctions, and they are highlighted on slide 4. This webinar is a production of Financial Poise, and more about Financial Poise is available on slides 2 and at the end of the deck, slide 44. I also call your attention to slide 41 at the end of the deck. Steve Strausser has very kindly offered our Financial Poise community a discount on his book, MBA in a Day 2.0, What You Would Learn at Top-Tier Business Schools if you only had the time. And he provides information with regard to checking out and a promotional code of Financial Poise for his best-selling book. All right. So if you are attending this live premiere for the webinar, you can submit questions using your web portal. You also have an opportunity, if you're watching on demand, to submit questions after watching the webinar. Those instructions are on slide 35. Slide 35 also provides any information with regard to comments on this webinar. All right. Slide 6 provides a disclaimer. We wouldn't be doing our job as lawyers and professionals without a disclaimer. So don't go out and act on what you hear during this webinar. You are not our clients. We are not your lawyers or accountants. We are here to provide general education so that you can communicate better with your trusted professional advisors. This advice is not personal to you. Okay, thanks for your patience. We will get started, and I will navigate over to an introduction to the balance sheet. So the balance sheet is an essential, we'll say, key financial disclosure. They're important to understanding businesses as well as startups. They tell you what the company has in terms of assets, what they have in terms of liabilities and debts. And if you subtract debt from asset, you will get the net worth or shareholder equity in the company. There's some nuances to all of those words I just used, and we'll be talking about them here in this webinar. But as a very general glance, if shareholders' equity is negative, the company's debts exceed the value of its assets. If it's positive, the company is generating value for its investors. The balance sheet is captured as a snapshot at a point in time, either on a quarterly basis or an annual report, 10K. It does change over time. The balance sheet conveys a significant amount of information to an educated reader. On slide 13, you'll see some examples of what you can learn: the amount of debt relative to equity. You can learn about the speed of paying its bills, accounts receivable, right, versus cash, increases or decreases in short-term cash, the percent of assets that are tangible, the percent of assets that are based on accounting transactions. You have concepts of short-term and long-term liabilities. You get a basic understanding of the liquidity of the company and the nature of its assets. So with that, I'm going to kick off our conversation here, starting at slides 13 through 15, and ask Terry to kick us off with some basic rules of the road on the balance sheet. We know that they're summary financial statements. We know that there are other financial disclosures that accompany the balance sheet, in particular an income statement and a cash flow statement. So Terry, can you preview for us how these three financial statements differ from each other? Who wants to see your balance sheet? And what does the balance sheet show that the other two do not, and vice versa? So take us through basic financial statements 101.
Okay, thanks, Candace. And I want to thank those that are in attendance today and listening to this presentation. I'm going to start again, somewhat a bit repetitive with what Candace, how Candace started, tell you a little bit about the balance sheet and then the other statements and how they differ. So a balance sheet, as Candace said, is a snapshot of the company's position at a specific date. We'll go through the other financial statements and the time periods they cover. Balance sheet outlines how much a company has in assets, how much is owed, debts or liabilities, and net worth, all of what Candace identified. Generally recorded at cost, or a balance sheet is recorded at cost or lower of cost or market. So the lower of cost or market means assets are reported at cost unless an asset is impaired. Then you write the asset down to its market value. But you don't write, typically, we're going to cover some exceptions to this, but typically you don't write assets up to fair value. Assets typically are listed in order of liquidity between various classes of assets. So those that are most liquid are listed first. Those are your current assets. Cash generally being the first item in that grouping. Then you have non-current assets, and then other assets that can be grouped outside of typically your debts and things that might be in non-current assets, or not debts, but your long-term assets. Assets have three essential characteristics: has a probable future benefit to the company, so they have a value. The company can obtain and control this benefit, so they have an ownership interest in those assets. You can't put assets on your books that you don't own, and then events that allow the company to control the benefit have occurred. So if you were looking to sell an item, that sale has occurred and you have the receivable from that sale or the cash from that sale. You can't book assets based on some future event, typically. So unless the benefit for doing so has occurred. Liabilities include debts and financial obligations arranged in order of liquidity. Current liabilities are first, and then concurrent or long-term liabilities. Liabilities have three essential characteristics. Represents a present duty or obligation to pay. Present duty leaves little or no discretion to avoid payment. So you do have an obligation that is, the companies to pay, and the transaction obligating the entity to pay has occurred. Again, just like the accounts receivable that we said, the event has occurred that creates that obligation. Equity is owner's equity, shareholders' equity, or net worth of the company. As Candace indicated, it's the assets minus the liabilities. It typically is going to include common shares, preferred shares, retained earnings, or some variation of those. The equity section will vary based on the structure of the entity, if it's a partnership or corporation, and various alternatives to those partnership or corporation structures. Differences between a balance sheet and an income statement. Income statement is measured over a period of time and measures a company's revenues matched with related costs, resulting in net profit or loss. Net profits roll into or are included in retained earnings of the balance sheet. So there's that linkage between an income statement, which covers a period of time, and over that period of time, if it generates so much revenue or losses, those revenues roll into the retained earnings of the balance sheet if the balance sheet is measured at that ending period. Differences between the balance sheet and the cash flow statement. Cash flow statement is measured over a period of time, like an income statement. Cash flow statement shows changes in cash from the beginning of the measurement period to the end of the measurement period, compared to the income statement. So it has that linkage to the income statement. It shows where cash is coming in and going out. It's typically grouped in three categories. It's cash from operations, cash from financing, and cash from investing. So with that, I think that's my summary. Thanks, Candace.
Yeah, so thanks, Terry. That was a very comprehensive overview about the balance sheet and its relationship with our other financial statements. So let's do a quick hypo, and I'll pivot to you, Steve. So you're a prospective investor and you've requested 3 years of financial statements, including the balance sheets. Could you talk about what you're looking for and what is important to understand in that context and about the balance sheet?
Okay, well, I mean, if I'm a buyer or an investor in the company, I think the things I would zero in on are how much of the value that's shown on the balance sheet is in the form of real tangible assets. In other words, stuff you can really, put your hands on. So, what am I getting for my investment? What is sort of, so to speak, a collateralized look at my investment? How secure is it? And then I think the second most important thing that the balance sheet can show is how capable is this company in terms of meeting its obligations, liquidity aspects of the company in the form of cash or assets that can be converted to cash quickly. So those are probably the two, for me, the most important parts of what I can get from looking at a balance sheet. And on the converse, what are the liabilities? Are they, really extreme? Are those liabilities, if aged, going to create heartburn for the company to service? But liquidity and the nature of the assets, I think, are two important things.
Yeah, so quick follow-up question. So you've asked for 3 years of financial statements. So what are you looking for in terms of, say, for example, trends? So why 3 years?
Yeah, no, that's a good point. Well, yeah, the reason for the length of time is exactly to see what the trends are, to see if the company, for instance, is over that time increasingly relying on debt in order to meet its, cash needs. So that to me would be kind of a red flag. We're going to talk about ratios, a little bit later, but what is the trend of those ratios? Over the 3 years, are we seeing an increased ability to meet obligations or maybe a decreased ability to meet our current obligations? So, very good point is that you really, because the balance sheet is a snapshot at one day in the life of the company, having 3 of those days over time is much more valuable.
Yeah, that's fantastic. So, John, we've talked a bit about how we work with our financial statements with a focus on the balance sheet. So we're going to do our comic book hypo, but now in the context of looking at the balance sheet. So I own a comic book store. I buy and sell comic books. I pay rent. I don't have any employees. I have $57,000 in my checking account. I owe vendors about 10,000 and about 10 collectors and dealers owe me a total of about 100,000. So with those facts, what does my balance sheet look like? And who would want to see my balance sheet?
All right. Well, thank you, Candace. The points that Terry and Steve mentioned lay a good foundation for this. Before I give you a specific example of what the snapshot might look like, I just want to touch on a few of those concepts. Terry mentioned the matching concept, matching of expenses with revenues. Well, the balance sheet, some of the items that are assets or liabilities also are cumulative reflection of revenues and expenses. So I'll touch on that. There's an entity concept. He used the word I several times. So whether this is organized as a sole proprietorship, like you have no formal entity structure, or a general partnership, or a corporation, which is a creature of state law, where it actually is technically its own legal person entity separate from you, or some other version. Under GAAP, we look at the enterprise as an economic entity. The third is Terry talked about historical cost. Assuming we're using US generally accepted accounting principles, accrual basis accounting, most of the time the assets are recorded at historical cost. And then timeliness is very important. So a balance sheet is measured as of one point in time. I use the word snapshot. So if we're looking at a balance sheet and you mentioned like a checking account or what you owe vendors or what dealers owe you, that's measured as of one particular point in time. So let's assume for our hypothetical, it's December 31st of 2024, which by now we're in late February, it's a couple months ago. But quite often, companies look at financial statements as of a certain point in time. Year end is a common time to think about doing financial analysis. So with that said, what would this balance sheet look like? Well, we've been talking about a balance sheet with the word balance. What's balanced? Conceptually, assets are on the left. That's what you own. That's what the entity owns, whether it's separate or whether this is just a sole proprietorship, which is an extension of the individual, or over on the other side, the liabilities, that's what's owed. And we'll get to the basic accounting question for balance sheets: assets equal liabilities plus owner's equity. Owner's equity is the residual. It reflects the accumulation of what's left over. But the balance sheet is an accumulation of every accounting entry that's ever been made for every transaction. Even what's done in the income statement at the end of a period gets closed out to the balance sheet at year end. So with that said, on the balance sheet, on the asset side, the left side, so to speak, what would we see if we had a column for assets? We'd see cash of $57,000. And the assumption here is that's the actual reconciled cash balance. That's not merely what the bank statement reflects. because there could be deposits in transit, there could be payments like checks or transfers outstanding, which would not yet be reflected in the bank statement. But assuming that that is the correct reconciled full balance, 57,000 will be on the left side. Receivables of $100,000 from the other collectors and dealers that owe your comic book store. Inventory. You haven't mentioned inventory. So it's possible, maybe the way you do business, you take product on consignment. That means that you don't actually purchase it. That means that the other owners still hold on to it. Our listeners, if you think about how a lot of secondhand stores run, there are a lot of secondhand stores that effectively take product on consignment. They don't take title to it. They don't buy it. If it's sold, then the owner of the store takes a commission or takes a fee for marketing and presenting those goods for sale. If you did own the inventory, but you didn't have records, since we're under a typical historical cost basis, that inventory might be listed as zero if we're doing GAAP. On the other side of the balance sheet, under payables, under liabilities, there'd be vendor payables, rent. How do you occupy this space? If you have a lease, you may have rent payable. You also may have income taxes payable because your business here may have generated income during the period, which is subject to income taxes. So that's what will be on the right column for liabilities. And then the net, the difference would be owner's equity. If you're proprietorship and it's positive, that would be what you as an individual have as equity in this business on an accounting basis.
Is that the same as what my business is worth?
No, it's not fair market value. We're talking about under US generally accepted accounting principles. Under accounting conventions, we're talking about how this would be recorded. The value of a business is something different, but the accounting information is an important consideration in putting together a business valuation. Usually, a business is valued either on an income approach, a market approach, or a net asset approach. But that would be based upon the expectations of the future for the business. Basically, an owner or a buyer are looking at a business, if they're doing a valuation, as the present value of the expected future benefits of ownership.
Okay, so let's talk about, say, my inventory. So I am terrible at bookkeeping. I don't know what I paid for it. I don't know what it's worth. What would you do in terms of capturing inventory for the balance sheet?
Well, would take an inventory of the inventory, so to speak. First, we want to know what there is, and we want to make sure we have good records. But from an accounting perspective, if we don't have records of what we paid for it, ordinarily we would not be like estimating values and then going and recording that in the balance sheet. Generally, the balance sheet is based on historical cost. And so what would happen in such a situation, unless there's some documentation of the historical cost, that whenever a sale of the inventory occurred, the revenue minus the cost of inventory would be the gross profit. And here there'd be no cost of inventory to be recognized. So that differential would be 100% gross profit. The difference between gross profit and say operating profit is there are other expenses, like you may have rent expense or other expenses to in operating the business. But you mentioned you owe vendors about $10,000. So the follow-up question on inventory is, what were you buying from vendors? And is any of that items that really should be part of the items recognized in the cost of inventory?
Yeah, that's fantastic. Thanks, John. And let's just assume I am actually doing a good job tracking my inventory. And I will pivot over to Steve. So let's say I actually know what I paid for all of the newly published comic books that I buy each week. So I am buying, so hence why I have that liability. And I know what I've paid for my rare comic books, right? You know, top shelf comic books. However, I often buy entire collections for just one flat price. So could you talk about what that means in terms of the types of assets and how we're valuing those assets for the balance sheet, Steve? And do we have any other things to think about, including, say, depreciation?
Okay, well, thanks. Yeah, in this particular hypo, we have kind of a unique situation, especially when you're buying an entire collection at bulk for one price. How do you value, or how do you get the cost of each of the items that you might resell out of that collection? I mean, the obvious way would be just divide it, by the total purchase price by the number of comic books. But there might be variations within that. So that becomes a kind of a sticky wicket in terms of how you come up with an actual cost of that inventory. The other aspect of this is that the depreciation notion, I don't think really comes into play much, unless you have some sort of standard of degradation of the product itself over time. But depreciation is more appropriate to assets that have a service life that at some point have to be replaced. So, by applying depreciation, we're accommodating the ability for us to, down the road, have to replace that serviceable asset that has a predictable lifetime. But comic book, I think, would be very difficult to do.
Okay, and could you address this thing I see every once in a while called goodwill? What is goodwill? And how might it apply to my comic book business?
Right. Well, goodwill is usually the biggest sticking point in the buying or selling of a business, because it really affects the valuation of the business. And nobody wants to know that they have an ugly baby. So every business has this shining upside and increased value. We call it, sometimes it's called the habit of patronage. In other words, if you're buying a business that is an a going concern, there's a certain value to the fact that the day after you buy that business, there's going to be somebody coming in the front door as a former customer. That drives the value of the so-called goodwill. So goodwill is what intangible value is placed on the fact that we have built a viable and assumingly profitable kind of business.
Yeah, so all right, we like goodwill, and we also like valuation. So Terry, why don't we pivot and go back to what is this company worth? Which is the balance sheet, we've been told, is giving us some values. There's accounting principles at play, but it's not a valuation tool. Is that fair to say? What
Yes,
does this mean?
yes, Candace, that is correct. It's not a valuation tool. Yeah, I think John addressed this, and I think I mentioned it as well. GAAP is the accounting standards that's followed, and so assets are reported at the lower of cost or fair market value. So if an asset is impaired or has declined in value, it should be written down to its fair market value, but assets are not written up to their fair market value generally. We're going to address some issues, I believe, coming up, just recently, cryptocurrency can be written up because it does fluctuate in value, and share values of investments in companies vacillate. So there are some assets that are reflective of their fair market value, but generally it is, in this case, in our example of the inventory of books, it would be based on the purchase price, and then if you paid more than the fair market value for those for those books, then there might be some goodwill. And if there were impairment or degradation of those assets, it would first go against the goodwill and then against the assets. And so what you are left with is not assets that are written up, but written down for any type of impairment below their cost value if there is decline in value.
Yeah, so what we have here, though, is the balance sheet can be used for a lot of different kinds of ratios, right? And we've mentioned ratios a few times. And so there's something that we can really use the balance sheet for, and this might be related to performance or comparing my company to other comic book stores, but it's probably not good in terms of valuation, as what we've just discussed. So why don't we talk about some of these ratios, and there I'm going to direct us to slides 29 through 34. And what we're going to do here is let's talk about a few of them. So John, could you give us some preliminary comments about the ratios, and then we'll turn to Terry to talk about the current ratio.
Yes, thank you, Candace. We'll talk about ratios, and I wanted to mention that one of the or two of the important accounting concepts that relate to this is, if we go back 100 years ago, before there was a Securities and Exchange Commission, before there were the securities laws of the early 1930s, there were no regulations encouraging or requiring at least publicly listed companies to have consistency or comparability in their financial statement information. So today we have almost 100 years of those rules since the early 1930s, and their evolution and the addition to them, and the practice and the growth of companies that now, where many of the US companies have become global to some extent. There's a lot more comparability and consistency. So I'm mentioning those two accounting concepts. They are US GAAP concepts because when we're looking at ratios, we're assuming that however the financial information has been presented, that it has been done on a reasonably comparable and consistent way. That said, we can compare ratios in the balance sheet between different aspects of assets, liabilities, and equity, or even with the other financial statement. That one of the four key financial statements is also the income statement. We can compare and do some ratios between revenue, expenses, and assets and liabilities, and equity as well. But we can do that because of this assumption of comparability and consistency as to how they're presented and accounted for. So you're going to look at how am I doing? You're trying to look at how's my company doing versus itself historically, like you mentioned, trends. We're looking versus peers. We're looking versus industry operating statistics. There are surveys that are done in various industries. But the other thing you mentioned earlier, Candace, I should talk a little bit about too, is who's this stuff important to? It's not just important to you. It's important to potential investors. It's important if you have a lender, and your perspectives and what you're looking for may be different. A lender may be looking to protect their loan. They're looking at your credit worthiness. A potential investor may be looking at this as looking to buy the business, and they may have different objectives here. And you as the owner, assuming that you have an objective that many business owners have, even if you were a large company and you had lots of shareholders or investors, are you looking to maximize the value of your business? So things to a creditor, a lender, like having a large cash balance, low payables, may be important to them, but either you as the owner and manager or an investor on the outside might also be looking and saying, hey, you the operator of this comic book store or chain of comic, how effective are you in deploying your resources? You have a big cash balance there. You could be doing something more with it. Why aren't you reinvesting it and opening more stores? There are things that can be told from these ratios that when you put it in context and figure out whose perspective is driving the motivation for the questions, make a difference. And I think that Terry and Steve are going to talk about some specific ratios, but putting it in context is very important. And if I could offer one example, this assuming comparability and consistency, we're assuming reliability as well. That's a fundamental concept of GAAP, representational faithfulness and reliability. If we go back 30 years ago, there was a company called Farmore, Phamor. They were in Toledo, they were in Pittsburgh. Sam Walton, the founder of Walmart, said, there's one company I'm afraid of, Farmore. I can't figure out how they're doing it. They're putting up stores, they're reporting lots of profits, and they're growing and growing and growing. Well, as it turned out, one day an article gets on the front page of the Wall Street Journal. There's $500 million of inventory missing. This is a company whose primary product is health and beauty aids. So you could imagine that's a lot of bottles of shampoos and aspirin and the like and razor blades. It turned out it was a scam. And how they did it was they consistently reported a 20% gross profit margin. And there was a lot of mischief going on behind the scenes. You can look it up. You can find lots of stories about Farmore. But I'm also pointing out we're assuming reliability of the information. That's so critical. And one of the things with Farmore, Sam Walton couldn't figure out how they're doing it. They had very high gross profit margins compared to all the peers, but that was how they were reporting it. They were manipulating the numbers.
So if it's too good to be true, it probably is, yet again, in forensic accounting.
It might be, but on the other hand, we have to keep in mind there are new players, especially in the 21st century, that have come along and they have been able to generate some higher profit margins in their niche. So you have to put it in context and figure out whether the business model is for real.
That's a good reminder, and that's another reason why it's important to look at these comparables. All right, so Terry, why don't you take us through our first ratio application, and that's the current ratio.
Happy to do so, thanks. So current ratio is your current assets divided by your current liabilities. Those are typically subtotaled on the balance sheet. It's a simple method for determining a company's ability to repay short-term liabilities. The higher the ratio, the stronger the company's current financial health. A ratio below 1 is a red flag, indicates that a company may struggle to pay short-term liabilities.
Right, so Steve, how about working capital? What do we do in terms of working capital?
Well, really closely related to the quick ratio is it's just a simple comparison of current assets and current liabilities. You know, current assets meaning that those assets are likely to be converted into cash within let's say a year. Current liabilities are things that we have to pay generally within a year, and the comparison between the two, hopefully the difference is a plus, that our current assets are more than our current liabilities, meaning that we have a positive amount of working capital.
Hey, so Terry, take us home with debt to equity ratios.
Okay, so the debt to equity or D&E ratio is financial metric used to evaluate a company's financial leverage. It's calculated by dividing a company's total liabilities by its total shareholders' equity. The formula is debt, total liabilities divided by shareholders' equity. The ratio indicates, helps us assess the extent to which a company is financing its operations through debt versus its own resources. A higher D&E ratio indicates more reliance on debt, which can imply a higher financial risk, while a lower ratio suggests less reliance on debt and potentially lower risk.
Okay, so in quick summary, it looks like the balance sheet gives us a lot of data. It helps me better understand my company, just in terms of my own performance, but also my performance relative to my peers. It may tell me about opportunities to do things differently. For example, if I'm building up a lot of cash, maybe I have an opportunity to pursue some investment or some debt pay down or, other sort of maneuvers in terms of how I use my capital. So it looks like valuation, but it's not a valuation, but there's a lot of important information that is in the balance sheet. All right, Steve, why don't we take a step back? This was a lot. We've talked about assets equals liabilities plus shareholders' equity. We also see that nifty formulation here on slide 16, but sadly, I don't understand it. So, Steve, can you help us make use of this formula?
Sure. Well, let me just give you a very simple example of, how to determine, I think what we're trying to do is determine what equity we have in our company. So let's use the example of your house. So let's say that you have a contract to sell your house. You have a specific number that is attributed to the selling price of that house. So that's the asset. Okay, that's the amount of the asset. Now we have a loan or a mortgage that we've taken out, and the balance to pay off that loan, let's say the house is worth 600,000, that's the sale price. We have a mortgage that has a balance of 400,000. Those are our liabilities. So if we deduct the 400,000 from the 600,000, we have $200,000 worth of equity in our home. It's the difference between what we have and what we owe against an asset in very, very simple terms.
Okay, I think that's really helpful. So thanks a lot. And of course, if my liabilities exceed the value of my assets, then
And you're
it
upside
looks like
down.
my equity might be negative.
Yeah. Yep.
So that might be a red flag there. All right. So John, why don't we focus a bit on each component, and we're going to start with the asset side of the equation, and I will direct the audience to slides 17 through 21. So can you explain how the assets are broken down into current, non-current, and other assets?
Yes. Terry touched on this a little bit ago. I'll talk a little bit more specifically. Uh, the ordering is based upon liquidity. Terry had mentioned typically 1 year or less is viewed as a current asset. That's sort of a rule of thumb. The theory behind this is looking at the operating cycle of a company, how long it takes to convert a sale, to convert revenue into collected cash. That's the concept behind it. So current assets are generally assets that are cash or cash-like or would be converted into cash within 1 year. That's things not only like cash, that's in most companies, that's going to be accounts receivable from customers. It's going to be inventory, at least inventory that is expected to timely sell. Non-current assets would be items over 1 year. Steve touched on this as well, would include some of the fixed tangible assets, like if a company owns, say, trucks, property, plant, and equipment. Other assets aren't necessarily looked at by order of liquidity chronologically, but these are assets that don't readily fit into the other timing categories. And very commonly, what's here are things that are not really the core drivers of the operating income of the company. It may be things like land held for future development. It may be investments in other companies where the investments are in closely held private companies. And so that's most commonly what's in those three categories.
Okay, that's very, very helpful. So Terry, do you have anything that comes to mind that could also illustrate issues with regard to current assets? So for example, some cash that might be inaccessible or some novel assets such as crypto.
Um, so, you know, kind of this idea of cash is cash is not always true. You may have the cash, but a situation where you have a linked liability would be employment taxes and sales taxes are collected by the company but held in trust for the government. So you have a liability to turn those over while the cash is on your books. And then you could have funds pledged as security on a loan where you have to retain a certain amount of funds or assets that have been pledged and collateralized or are requirements to loans. Crypto is kind of the exception to the lower of cost of market. It was lower of cost of market until December 2023, and GAAP changed its rules on crypto. It's ASU 2023-08 and requires crypto assets be measured at fair market value at the end of each reporting period, effective December 15th, 2024. So you have those variations, and then you have accounts receivable where you know it might not be as liquid as cash or as good as cash. You may have accounts receivable that are no longer current assets or shouldn't be current assets when they're impaired. You know, where their collectability might become questionable or might take longer than a year. Assets that are classified as current are done so with the idea that they could be converted to cash within a year. So if you think it's going to take longer to convert something to cash, shouldn't be carried as a current assets. And then you might have investments in illiquid securities. So illiquid securities cannot easily readily be sold or exchanged for cash without substantial loss. So illiquid securities will be reflected as long-term or non-current assets or other assets. So those would be some of the examples of cash issues, and then items that you have to watch regarding their classification, whether they're current or long-term.
Okay, that's very helpful. And so in the interest of time, we're going to skip to the liabilities part of the presentation. And this is covered in slides 22 through 25. And maybe, Terry, you can just continue here. Give us a bit of a intro on liabilities on the balance sheet.
So I mentioned that current assets are going to be collected within a year. Current liabilities would need to be paid within a year, and they include such things as accounts payable, wages payable, interest that would be due within a year, warranty liabilities. So if someone buys your goods and you warranty those for 30 days or 60-day warranty, and you can return that. If there's an issue, then you know warranties that would potentially could be returned within a year would be current liabilities. Unearned revenue, so you've gotten paid for something but you haven't done the work, that would be an unearned revenue, and that if that were going to be earned within a year, so then that unearned revenue would be as a current, or short-term portions of notes and bonds payable would be current. Those things that would be payable within a year. And then non-current or long-term liabilities include such items as anything that's over a year, such as long-term portion of notes and bonds payable, and long-term obligations where they're not payable, they're payable beyond a year time period.
Okay, so we have then one last category, that's equity. John, can you talk to us about equity and maybe some nuances to have in mind when looking at equity on the balance sheet?
Yes, thank you. I mentioned a little while ago that there are 4 key financial statements. If we were to look at complete audited financial statements, such as those issued by publicly traded companies in the United States, we'd see the balance sheet, the income statement. We'd see 2 other key financial statements. We see the statement of changes in equity, and we'd see the statement of changes in cash flow. And then we'd see the notes, and we'd also would see in the front an independent accountant's opinion, basically the auditor's opinion. The statement of equity, if we want to look at equity, we want to consider both the balance sheet, where it reports the components of equity, and also the statement of changes in equity. Retained earnings are a key part of equity of a corporation. Those are the accumulated amounts of net income. There are other components, though, to the balance sheet, and to see what has caused changes in those balances within equity, the statement of changes in equity is the other place to look. So retained earnings not only reflects the accumulated net income of a company, it also reflects subtractions for any distributions from that amount of retained earnings, such as for dividends. And also within the equity section, we should see whether there is more than one type of equity. There may be common stock, may even be more than one type of common stock. There may be preferred stock, I'm talking about in a corporation. And we also should take a look at the liability side, because it's possible that there is a type of debt such as convertible bonds, if the company has issued convertible bonds, that might have some convertibility into equity. And so if it's a small company, you may not have all these different components of equity. Like if your comic book store, which you mentioned earlier, is a sole proprietorship, basically you'd have one thing, your owner's equity that you own as an individual. But in a corporation, as it grows and looks for other sources of capital, it may have more than one component to equity. Preferred stock I'd mentioned. Usually in the sequence, we'll see in the equity section, if we're looking for the classes of stock, preferred stock will be listed before common stock. That's because in theory, in a financial liquidation of a company, if that were to hypothetically occur, the preferred stockholders get paid first. But as you'll see, if you look at a formal set of financial statements, equity comes after liabilities, where any debts would be. And if there was a hypothetical liquidation, typically the debt gets paid first before the equity holders.
Yeah, that's really helpful. So I'll note that we still have some analysis that we could do here. So I'm going to pivot to Steve to talk about a vertical analysis, and I'll just recap, the equity slides are on slides 26 and 27, but let's zoom up here to slide 29. And Steve, could you talk to us about vertical analysis?
Sure. I mostly associate this with its application in an income statement, vertical analysis. And I'll defer to my accounting colleagues about the term common sizing of a statement. But what it means is we take each line item and express it as a percent of something. And usually in an income statement, it's percent of revenue. And by doing that, giving us a percentage, we can compare not only ourselves over time to see how those percentages change, but in a lot of cases, if we're in an industry that has an industry association, that association may collect operating information from lots of companies and create an industry analysis of the percentages. So if I'm, let's say, in a tire store business, and my labor cost as a percent of revenue is 15%. And I'm a member of the United States Tire Store Association. And that Tire Store Association collected all this information from 1,000 tire stores. And nationally, that percentage of labor is 12%. It gives me a basis for thinking, well, maybe I have too much labor. So to me, it's just taking the line items in a statement and expressing each of those as a percentage of a very important comparative.
That's great. And I'll also note that as we're doing this comparative analysis, we also have the concept of horizontal analysis that's on page 30, and that can help provide us with more insight on the trend analysis. But let's go to red flags for our last few minutes together. And Terry, I will ask you to tell us, okay, you have these financial statements, you have some balance sheets on hand. What are red flags to look out for?
Well, I think, the initial ones would be, are those financial statements audited? Have they been looked at by someone that verifies that they followed appropriate generally accepted accounting principles in putting these financial statements together? The other thing would be is if there's any annotations or any sense that they haven't followed generally accepted accounting principles. And this may be something industry uses that may be different from the way GAAP reports an item, but non-GAAP measures eliminate the possibility of comparing companies one to another and allows companies to cherry pick in ratios and statistics that make them look better than other companies. This is something non-GAAP accounting is something the SEC is focused on extensively, and in public companies, there will be some non-GAAP accounting that's designated in footnotes. But again, those are some of the initial red flags I would be aware of. And then the last would be if you're looking at financial statements that might have off-balance sheet types of items, if you're looking at the balance sheet specifically. Those would be items that don't appear on the balance sheet, but would be items that have a liability. So like rent. If you have rent, you have a commitment to pay rent out into the future, but it doesn't appear on the balance sheet. It appears maybe as the current rents that's due, but the long-term rents that are due might not be reflected on the balance sheet. So there are items that you have to question when looking at a balance sheet.
Okay, so Steve, do you have some red flags to add?
Well, yeah, my world is mostly focused on startups and new ventures. So I'll take that perspective. What's important is cash burn. How many months of cash do we have cash? How many months can we operate on the cash that we currently have? How much dry powder do we have? In startups, there's also a big issue as to how do we value intellectual property. So let's say we have a patent that we're relying on as the basis of our business, and we show that as an asset. What is the value of that patent? I mean, it could be as low as $1,200, the filing fee, or we may take a market approach and try to capitalize the future value of that intellectual property. and put that on our balance sheet. So that can create a huge variance.
Okay, so variances, surprises, hidden numbers, hidden activity, all could be red flags. Unaudited financials. John, we have just a brief minute. Anything else to add?
Look for opportunities. Red flags are also opportunities for management to potentially take action if they are controllable variables and influence and improve the financial performance or return on investment of the business. And for prospective buyers, there are also opportunities, perhaps if they are looking for buying a business that they might be able to improve, and maybe they can get a discounted price compared to what they think it's worth in the buyer's hands. These are opportunities. So the flags are not necessarily a dead end negative. They may be opportunities for management or a potential buyer to improve things.
That's wonderful. This has been a very rewarding conversation. I've learned a lot. Thank you to our audience and thank you to our panelists, Steve, Terry, and John. We hope you enjoyed today's webinar, episode number 2 in Financial Poise's MBA Bootcamp series. We thank you for listening. Have a great day.
Thank you.
Thanks.
Bye-bye. Thank you, everyone.
Thank you.